All right. Good morning, everybody. We have the 10-year auction today, so it won't be a completely boring day. Um, and I was doing some work with AI, just always poking the bear. And I had an idea about CPI seasonality. The idea that what if all the CPIs that we get aren't necessarily equal, and that sometimes CPI is more important than other times. That's kind of odd, right? That's like trying to say one of your dogs is more important to you than one of your other dogs, right? You're not supposed to have favorites. But there is an argument to be made for a particular CPI to be more important than other CPIs seasonally, not directly connected to a particular FOMC event or an FOMC decision, just generally speaking, is there a CPI within the year that could have statistical significance? And it's the June CPI that the one that we're about to get. So I'll post what AI had to say about that. It's a little bit of insight. It doesn't change the game, right? But the more we can understand the potential impact from any event, then the better we can plan for it. I changed the color of the June CPI from last year. I don't have more CPI prints on here yet, but I'll just add them through the day today, and maybe put a couple more years on here to see that June CPI. We'll see what we get out of it. Last year's, it was already in that move from QRA and FOMC. So it just continued to do what it already had been doing. Wasn't much of a change there. But yeah, I'll post it. You guys can read it at your leisure. It's not like a book, AI only writes a couple of sentences. So short, sweet, to the point. Outside of the 10-year today, we really don't have a lot of stuff on the table. It's still hurry up and wait mode. So the 10-year today, CPI tomorrow morning, and then FOMC after that. We still have the expectation of holding the range, but that the range is going to expand a little bit like a megaphone pattern. Liquidity resides on the other side of the pivot, so it makes sense that we'll continue to, go a little bit farther, higher and or lower as we continue to push the boundaries or push the edges of the range. Japan is down the least this morning. It's kind of fluctuating with the S&P right there. NASDAQ, they're really close together, the S&P and the NASDAQ. There's been a couple times lately where they've been really divergent, where, there's a 20, maybe even a 30% differential between these, 0.25, 0.30. And they're running pretty close together this morning. It's nice to see them back in sync. Small caps from the US group down the most, more than 3/4. It was interesting. They were doing an interview yesterday about how other nations around the world are either already cutting or are signaling a cut. And the question was, how do you think that's going to affect the Fed? And, usually when you listen to those kind of interviews and discussions, they want to draw out the answer and, him and haw, maybe blah, 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 just dragging it out. But the answer straight out was, oh, the Fed don't care. They don't look. They don't, they lead, they don't follow. Uh, just cut it to the quick that the Fed don't care. So if you were already looking at Canada and Europe and the others that have started cutting or are signaling that they're going to be cutting soon, and thinking, how's that going to impact the Fed's decision and the dot plots and the Fed don't care? They don't show the auction here as having any historical impact, but the 10-year is like, that's my baby, that's my sweetheart. I like the 10-year and the 30-year, but again, you're not supposed to have favorites, right? You love all your kitty cats the same. Pay particular attention to the clock when we have these auctions. They absolutely can move markets, and it seems like I'm just the only one ever beating the drum on these things. But if you day trade and you never pay attention to these auctions, then when you get ran over, you know, you can just say, well, I didn't care because I don't ever look at these things. Match them up with chart moves. It's pretty simple to just go back into a daily chart and look at a new hour like 1 o'clock or 11 o'clock or 11:30. That's when we get the auctions, 11:30 and 1, and see how often the entire day changes right at 1 o'clock. It's not always an auction, it can be something else, but watch the clock. It's one of the best indicators you can get, and it's free. It doesn't cost you anything. I thought there was one more European central banker to speak after noon today. I'm not seeing it now. Can't remember which one of these sites that I picked it up on. So the volume is pretty good considering we're in the hurry up and wait mode. Looking at 74,000, holding in a reasonably decent range. Take a moment to examine the channel. Gonna leave that box on here for the week. We are close. Let's just start with the ADR. We're close to the lower end of the ADR. So very likely we're going to find that lower ADR first before we do anything else. That's the average daily range. And just like it sounds, we'll expect the market to do what it has been doing on average over the last 21 days, because this is a 21-day average daily range. It is higher than yesterday's low, so we could overshoot just to get into that liquidity of the Globex low and the RTH low. We got two different low side pivots. If we get there early enough, it still opens the door for us to go to the other side. So we could hit both of these today, especially later in the day when we get the auction at 1 o'clock. We do have an overlap in the pivots. So today's central pivot is within yesterday's, not by very much. I had to zoom in to see it, but it is there. And we are on the underside of the pivot point. We do have S1 between us and that lower ADR, although it's not by much. I bet those two are almost overlapping each other at this point. We're still above the weekly pivot, but we are adrift, and we still have the expectation of a sideways market. So just like we were talking about yesterday, uh, you know, buy into weakness, sell into strength. We're not expecting the breakout until we get through FOMC. It's a wide channel too, not as wide as some that we've seen, right? Like last Thursday, but a wide channel reinforces the idea that we're not going to break out and expand today. So we're just going to continue to play the range. There's no hedging yet, so they're not concerned. Because of the 10-year today, it wouldn't hurt to keep your eye out to see if any hedging starts to show up. If you don't have Think or Swim, you can look for that hedging in the options chain. Even Tradeovate has options, right? So you can go in and look to see if they're hedging. They'll use out of the money options, and it'll be in the front expiration. So it's not like you have to go in and examine a bunch of expirations. You'll be able to see it. It'll be right up front. It should be a significant outlier in volume, right? It won't be, we don't want to see subtle. Now, I looked at Tradeovate's options chain last week, and I didn't see an implied volatility average. So that's a little bit of a handicap if you're trying to spot like a market maker move, because we use the implied volatility average to witness whether or not there is a market maker move. If that average in the front is greater than the average right behind it, then we know that there's a market maker move, and we know that they're hedging. Just look for that as we get closer to 1 o'clock. They'll start early, right? Somewhere around 11, 11:30. 11:30 is when Europe closes, so it should start to show up pretty easy at that point. If they're hedging at all, if they're concerned about the 10-year, well, then you should too, right? You should be concerned as well. We do have a voodoo line. It's this purple one, 53.50. We're above the 3-week, the 10-day, the weekly pivot. The 20-day is so far away, it's not even anything of concern. Zero gamma is underneath the put wall, which I was hoping that Spot Gamma would talk about that a little bit, and they didn't touch on it. I'm going to back up, check Friday, not Friday, yesterday evenings, read that and see if they mentioned anything about the put wall being rolled up or the zero gamma level being rolled down. But so far, I don't have any insight on that. And I'd like to get a little more clarity, at least. 10-day, 30-minute volume profile with a TPO. The TPO's point of control wasn't in sync or lined up like it is now when we were looking at it yesterday. So it just took some time. We had to spend time up here for it to finally move. The TPO profile, time, price, opportunity, TPO, I often call that volume by time, whereas a volume profile is a volume by price. We don't have a classic shape in the green profile, the volume profile, but in the TPO, we are starting to build more of a classic P shape. If we can revisit that 5,300 and build it out, then we would start to develop perhaps more of a B, capital letter B. Just remember, if you've been through the profile education, that it really isn't a B, it's actually a capital D. There's just two of them. You're still only going to get one point of control, though. The shallow area that we've been focusing on, that 53.32 cog line area, still got that shallow print, but you can see the reversals in there. We didn't leave a lot of volume behind on those reversals. It's very likely, that we were triggering in correlated markets at the same time. Still no point of control to carry forward. It's not a surprise. We're within the range that we've talked about yesterday. And as long as we're hitting this area, then we have no point of control that is an untouched point of control like we'd have down here at 52.85. This is an IX10 pattern, but it's IX10 inside of a really wide range, Friday's range. The best IX10 patterns you can get start out with a very narrow candle, and then we hold that very narrow range. Markets build up compression that way. You can generally get a really explosive move after you've built up, that sideways compression. We're building that, but it loses its luster when it's inside of a really wide bar. There is more insight to this if you're to use OCR style analysis. OCR is one candle reversal, OCR, which focuses more on how each individual candle can be examined as if it was a collection of candles, like when you are thinking about a trend, say this move to the downside. There was peaks and rallies, pullbacks, expansions, consolidations. There was a lot to read here. But if I went to a monthly, all of this price action would be one candle, right? Makes sense. Just like how you can look at your 5-minute chart and you're still understanding that that's one daily candle. So in OCR style analysis, this one candle represents a collection of candles, each one of these. So when we're looking at this, we had the high set, a new all-time high, but then we've got lower high and a new lower high underneath that one. We had a low set, but then higher lows and higher lows. So we are building compression here. This is a different compression than an IX10, which would just be focusing on a sideways market and, building up a lot of energy and considering where all of the liquidity is on each side of that. This is actually, constricting more and more and more. There's no promise of direction on this, just the expectation of a big move. It's not a surprise. We're already expecting a significant move because FOMC. That little bit about AI and how this CPI is different than, February or an August or whatever, any other month CPI, that'll add some weight to this too. This CPI is different in the context of where it lands in the year, how it's viewed by traders and institutions, just generally speaking, how it has nothing to do with our current situation. Well, I shouldn't say nothing. Nothing's the wrong word. That this insight on the seasonality of CPI doesn't only focus on how we are situated right now with the Fed and everything else. So the idea that we can get a big move before FOMC, either because of the 10-year, which is possible, but more because of the CPI, which is more likely, says that this big move that we're considering may be assisted with this compression, that it'll add to the strength of the breakout. When the breakout finally comes. Since we're holding sideways and we don't really have an expectation of our distance from 10 having changed that much, if we stay in one spot, the 10 is just going to come to us. We don't have to go back to it. So we're getting closer to zero, not necessarily because we're falling down, but because all we got to do is hold the line. And we're still inside Friday's range, so we know we're holding the line. This is for the weekly, more than 1.5% away from the 10-week. This is for the daily, more than 0.25%. The main thing is it's not zero, right? And that we're not below the 10. So no real change there. Really hadn't expected any change. We've got our range for the week. We've got our expectation of this bias that says we're going to hold the line. And we want to play that bias until we have clear, convincing evidence that it's no longer valid. So when we think about what we've been trading since Monday, which is to play sideways, sell into strength, buy into weakness, don't try to trade the breakouts. That if we get to the high, we want to reverse it, go the other way. If we want a significant, clear, and convincing signal that we actually should be buying that high rather than selling that high, then you're going to want to see in the liquidity, looking at the dome, the time in sales, looking at the cumulative delta, when we come up to that level and try to break out. I like using the 111 for a warning center. If price runs back to this high and breaks through yesterday's high, if it's going to reverse, considering it like a double top, double tops are bear traps, bull traps. It would only be a trap, though, if it's convincing. We got to get bulls to actually get in there so that we can pull the rug on them and drop them on their head. It wouldn't convince a bull to go long if price just comes up and hits it right on the dot. We need to expand through. Well, how far beyond the previous pivot do we have to go before it's considered a valid bullish breakout? And how far do we have to go and then reject to have a really nice double top bull trap? That 111 for me is that line in the sand. If we come up and we hit 100 perfectly, then this is just a cup. And I would look for a handle before going higher. If we come up and we go through 100 and we get into the 111, that's the really great double top pattern. It's perfect. Goes right up to that 111, stalls. It can even go above it a little bit, overshoot it. What we don't want it to do is go all the way to 1, 2, 3, 6. If we get all the way up to that and even say close above it, then it invalidates the idea that this is a bull trap and instead says this is a breakout, but you'll still have Friday's level to contend with. Then we would be doing the same thing. Put the 111 up there, look for the breakout, and consider getting tangled up in it. To the downside, it's the same thing. If we're looking for that double bottom, then we want to go lower than the previous low by at least the 111 so that we can get that bear trap and then flip everything over and run it back up again. If we look at just yesterday's levels, another way we can do that is to look at only the RTH of yesterday, not looking at the Globex at all. It is worth keeping your eye on what's going on with the dollar, the 10-year, at least one commodity. I had my eye on gold yesterday, but maybe crude would be the better play. Friday, gold was fantastic. Yesterday, crude was really good. You know, if we're supposed to be sideways in the ES and the NASDAQ today, then, you know, looking around for another opportunity, gold, crude, even Bitcoin as a futures product to play, it's not necessarily a bad idea. And I get it. A lot of people tell me, well, I'm still trying to figure it all out and I want to just stay on one market. I'm not disagreeing with you. You know, if you do want to get good at a particular thing, but at the same time, I see people say, well, I don't want to sit out. You know, they'll know that the day's market is going to be a trashy, kind of sideways, nasty market, and yet they don't want to sit out. They'll go in and trade that trashy, nasty market, anyways, just to have something to trade. And then their argument is, well, I'm in paper. It doesn't matter. I'm not hurting anything. I'm just going to go learn to trade trash. And all you do is end up picking up bad habits. So, you know, if it's trash, to find something better to play. The dollar is looking like it's going to break out. Have to consider the impact of the dollar getting above, say, 105 and a half, but I would be focused on that bigger level, the 106. So, you know, on the week, we're already inside week breakout off of this low. You can see the turnaround starting to pick up speed. We could evaluate just this pullback and see that we're above the halfway point. We do have this last big candle before the change in structure down here. So 105.45, which is really close to that, 105 and a half anyways. And then it puts maybe a little highlight around some more of that selling pressure. So keep your eye on the dollar. See if we're able to negotiate this breakout or not. What would be a really nice tell this morning is to see this rejection and a significant solid breakdown like what we had here. I mean, that's a really nice breakdown. It's one time framing, just single print, nice, clear, obvious flow. Even later in the day with that move there. So we're at the point where we could get that sort of rejection, see if we can get this kind of move out of it. That can offer a little bit of assist. Thinkorswim is still having issues with TNX. I still can't see it. So we're still using the 10-year, but it'll work, right? It does just fine, no problem. We're already at the lower ADR. Want to see if it's going to find structure here or not. We've been seeing for, you know, a long time the dollar and the 10-year moving in sync. Not perfectly in sync, but generally if one is up, the other's up. If one is down, the other's down, that sort of thing. And they're divergent right now. The 10-year is outside of yesterday's range to the downside and looks like it's going to get, you know, a breakdown on the week. And the dollar is testing yesterday's highs. So, you know, when it comes to getting some insight or some clues out of these two, approach with caution. When they're broke and they're just not helpful, then I mean, just acknowledge that they're just not helpful right now and that you're not going to get much out of them. We can play those swag levels like breaking out or breaking down or getting a significant move in price based off of key levels. But as for the tick for tick teeter totter move of, you know, the dollar goes up, the ES goes down, that sort of thing, I wouldn't attempt it right now. We're broke when it comes to that. There is also the idea if we're going to play this sideways range while we wait for the 10-year, then look for reciprocation around the VWAP. Whatever we get to one side, we expect to get on the other side. We can get near these ADR levels without actually hitting them. So you do want to look for any signals that we're actually turning around and going back up. One of those clear signals that we're not going to hit this lower ADR is getting through the VWAP and actually getting above it. Yesterday, the ADR was the goal. It was the target. And I got to say, it was disappointing that it took all darn day for it to get there, but it did finally get there. Friday, same thing. You know, we had the discussion earlier this morning that we can hit both sides if we hit one side early enough in the day. Now, sure, we had econ, so that helped, but we're going to get afternoon econ today, even if it is just the 10-year. The 10-year can have some weight to it. So, you know, to me, I never look at it as just the 10-year anyways. A little bit of a tip today, if we do get to the ADR and we pull away from it, but we don't continue to drive farther away, then anticipate that we're going to recheck that ADR and that we could actually go through it and get to the yellow line. Now, the example that I'm showing you here is the bullish direction where we got to an ADR, pulled back, but didn't continue through. So we came back and cut above and kept going. But we are closer to the lower ADR this morning. So this is what I'm referring to. We could come down and hit this ADR. Once we do that, we would expect to go in the other direction. But if it stalls out on that move back in the other direction and actually looks like it's going to come back and revisit that lower ADR, then we focus on the next level down. Of course, with all the measured moves along the way. There really isn't much of a reason to dig into what is gapped up or what is gapped down this morning, since we're in this hurry up and wait mode. But there is usually something that is bucking the trend, so to speak, right? Especially, say, penny stocks. Penny stocks are event-driven beasts. They don't care about CPI and non-farm payrolls and any of that stuff. It's more usually connected to a drug trial, you know, an event of some form. Bitcoin is down almost 4% this morning, depending on which ETF or ETN you're looking at. The 10-year down, like we discussed. Gold miners also down. China. Regional banks. And things that are up. Bonds, very likely on a reflexive bounce. Over the last 5 days, they're down 1.9%. This morning, they're up 0.5%. Sounds a little bit like a dead cat bounce. And nat gas. Nobody wants a rally led by nat gas. So, you know, not much of enthusiasm there. And some commodities. DBA is up this morning. That's a very significant move up after that incredible fall yesterday. Red to green, though. We closed at the absolute low of the day. We're already gapped up near the open of yesterday. Let's see if we can get completely out of that before 9:30. Then we can use yesterday's open as our support level and try to challenge these other levels higher. That is a very violent move, though. So approach this with caution. And when we zoom out, you can see that it's had a lot of drama. And I don't think that that drama is done. So, you know, if you're looking at DBA, approach with caution. Nat gas and DBA is all we got on the things that are up. We've got a lot that's down. Even the China ADRs are close enough to being down. It's your BABA, Baidu, JD, PDD, XPEV, Neo, that sort of group. Small caps also, down considerably. Big gap down in silver. At the most we could hope for is maybe a gap close, and I don't like, hope and maybe as a part of any sort of trade discussion. So, that's not a nice way to approach opportunity. If we can get back inside of yesterday's range, then level by level, I suppose we could work our way back up to yesterday's close. But I would want to, see more than this. Maybe more than just silver. Open up, a silver ETF, see some companies, mines, see if we're getting any precious metals like a XME or anything like that. See if we're getting gold moves, anything that can correlate to this to make the play easier. Short and sweet. Watch the clock. Keep your eye on the auctions today. I will see you all tomorrow.